Welcome to ACY Securities. I'm Ira Reyes, macroeconomic strategist. Today, we will discuss why gold and US dollar index both elevated and why with tech rally as well, it overcomes the tensions from the Gulf as markets brace as well for the critical earnings plus also the German index. Just a reminder, this represents my personal view of market movements and does not constitute investment advice. Trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize a dual-layered approach that synthesizes macro-level catalysts with technical precision. By cross-referencing fundamental shifts against statistical trends, I execute high-conviction trades where market sentiment meets optimized expectancy. So before we start, please don't forget to like, share, and subscribe to our channel. And for further information about in-depth analysis, you can join our discussion on Discord. The link is on the description box below. So let's begin. So for the European stocks, let's take a look. So ongoing right now, European stocks are set to rise today, and it is driven by strong investor confidence despite there's a high oil prices from the Middle East tensions, and markets are also reacting to lower UK inflation and strong earnings from Banco Santander and upcoming reports from other major companies. For the stocks, so again, the Nasdaq 100, it notched its best day in 3 weeks and rallying 1.9% as a rebound in chip makers and overshadowed as well the geopolitical tensions. And additionally for this, the S&P 500 as well, it rose nearly 1% ahead of major wave of corporate earnings reports from key technology companies. So the Wall Street staged a strong comeback as investors scoop up on the beaten down semiconductor stocks. And this as well led the rally. It comes from traders look ahead to a critical wave of these corporate earnings reports to gauge whether these massive AI investments are paying off. So to highlight for this week, for today, so Apple is well preparing to launch a new major leasing program called Apple Upgrade, while the Morgan Stanley has downgraded several software stocks over AI concerns. Meanwhile, the OpenAI CEO is set to brief the Trump administration on upcoming AI models as the US develops safety review processes. And additionally for this one, the major corporations, including the 3M, the General Motors, and Hasbro, all posted strong earnings beats and raised their full-year financial outlooks. Now let's take a look on the Trump administration or anything relevant to. So here, so US President pushed for American-made AI chips and is squeezing profits at TSMC as the chip maker builds expensive new factories in the United States. So to satisfy political pressure and trade policies, the company has committed a massive $200 billion to US expansion, which executives warn that it will dilute their profit margin for years. However, because TSMC dominates the market, so analysts say they can easily pass those higher production costs right back onto their clients. So what would be the implication of this one or influence? So of course, while there is a massive US expansion and costs and it would lower overseas profit margins, it could cause as well the short-term stock volatility. You can see the performance of TSMC with strong pricing power allow it to pass those expenses to the clients, and of course strong AI demand, and there is a strategic reduction as well of this geopolitical risk that help the company's long-term valuation. Next, we have update from the Intel. So the Intel Corp, it shares it rallied to 8.6% following the company's announcement that it will cut its an unspecified number of jobs within its data center unit to reduce the cost and restructure. So this organizational shakeup comes as the data center becomes help the business to drive a revenue rebound by meeting strong demand for AI processors, even as the company faces past losses to rivals like the Nvidia. And update for the Sony. So Mitsubishi Electric and Sony Group, they are also establishing a joint venture named Advanced Vision Solutions. So it's slated to begin operations this coming October with a 60 to 40 ownership split. So to provide factory automation services. And this collaboration as well, it would combine with Mitsubishi's automation expertise with Sony's advanced image sensors and AI technology to strengthen their competitive positions. So the initiative is a part of a broader push by the Japanese electronics firms to expand into the AI sector and also attract investor capital during these rapid technological shifts. Another update from Amazon, their corporate sales unit. So the Amazon business is already on track to reach its $60 billion in annual merchandise sales, marking a 71% increase from the year 2023. So this growth is driven by features tailored for large organizations, institutions, and government entities, which have brought the platform's total accounts to over 11 million. Another is from the SpaceX. So it is preparing right now for one of the largest share unlocks in capital markets history. So with up to $116 billion worth of stock becoming eligible for sale on August 6th. So this initial release of insider shares arrives just as the company faces a wave of short selling pressure and a recent stock slump following its massive IPO. And by early December, the total number of shares available for public trading is expected to soar to 5.33 billion as staggered lockup restrictions expire. Again, and another to highlight ongoing for the stocks, US and European stock markets, it closed higher yesterday, driven by a powerful global rally in the semiconductor and technology shares, following strong export data from Taiwan and South Korea. And the Asian markets extended their gains today. You can see the performance as well, with Japan's Nikkei 225 earlier it jumped to 2%, local chipmaker surge, and then the yen hit a fresh 40-year low. And these broad equity gains as well, it occurred because of the geopolitical tensions, plus the rising oil and natural gas prices, and also due to elevated treasury yields. For the commodities, let's begin with the wheat. So wheat prices increased for a second consecutive session due to escalating Black Sea conflicts and also declining crop forecasts in major producing regions like Russia and France. The ongoing attacks and shipping restrictions in the region, it heightened as well the global export worries, pushing us again the wheat up and significantly for the month. Meanwhile, corn prices reached a 2-month high driven by the same geopolitical tensions and adverse European weather conditions. So what could be the impact? So for the commodity markets, again, if there's a poor crop weather in the Black Sea region and this geopolitical conflict, it become the bottleneck major export routes, so driving the sharp spikes in global wheat and corn futures. And for impact on inflation, prices, of course, higher grain costs increase the prices of everyday food products and animal feed, and adding as well persistent upward pressure to overall consumer inflation metrics. For the gold, for the precious metals and crude oil, so it rose as well on yet today, and escalating geopolitical tensions and supply disruptions intensify the global inflation concerns. And because of these escalating conflicts involving Iran, so the Red Sea shipping attacks and strikes on Russian energy terminals drove Brent crude above $91 and other oil benchmarks to multi-week highs. Meanwhile, we see the recent economic data revealed a fourth consecutive slowdown in U.S. private job growth, influencing as well the market expectations for future Federal Reserve interest rate decisions. And investors as well continue to monitor these intersecting supply risk and macroeconomic signals while anticipating steady interest rates near term with potential rate hikes priced in later this year. So let's take a look first as well on the FinLogics. So what are we expecting? So yesterday we had a ZEW economic sentiment, which is positive for the euro and the German as well. And today we had a balance of trade from Japan and the United Kingdom. And tomorrow would be a big decision from the euro area. That would be the ECB interest rate, the deposit facility rate, and the press conference. So you expect more volatility as well by tomorrow. Now, looking at the gold, so let's take a look on the chart for the gold. So currently, it already hit the defense level that I was showing yesterday, or the retest to break the 40.50 to 40.64, and now it passed to 41 level, so it already reach as well the 40.85 level. So yesterday, if you will still remember, I mentioned there will be a short-term bearish trend for the gold. So again, the gold rose toward 4,200 an ounce today due to the Middle East tensions, plus the higher oil prices and slowing of the U.S. hiring. Again, geopolitical tensions because the U.S. president dismissed near-term talks with Iran and warned of more strikes, while the Houthi attacks in the Red Sea and strikes on the Russian pipeline raise energy and supply worries. And the U.S. economy with the ADP data showed the U.S. private hiring it slowed for the fourth consecutive month. And interest rates, markets expect the Fed to keep rates steady next week while pricing in a greater than 55% chance of a rate hike in September. So you can see as well, both the gold and the DXY are rising together because of the Fed expectations. Though we were expecting to drop for the DXY because of the ADP data, but it was supported more on the tension in the Middle East plus the interest rate. So currently, the price gold is already here. So at this level. So these are the resistance level based on a lower time frame that I'm looking at because of the trading range of the prices. So from 41.17, this is the doing price right now, and it could possibly hit the 41.24 level. Plus the next would be the 41 level or 41.65. So again, in a lower time frame, because gold, we can see the recent green bullish candles as well, attempting to recover from previous drops. And for the moving averages, so we are tracking both the 50 and 200 EMA for this one. So you can notice as well the price remains positioned below these moving averages. So let's take a look on a lower, higher time frame. There is a reflecting as well of a broader macro downtrend context on this time frame as well, and even as short-term bounces occur near the support zones. So here you can see the Bollinger Bands. For immediate resistance, we take a look at this level at 41 to 41 41.24, that's the nearest, and 41.65 where the current price is already pressing. So again, it's not yet on the side of, we are not entering yet the New York session, sorry. And at the same time, to the downside, we look as well on the structural support that is marked near at this level. So let's go back again to a lower time frame. At these levels, the 40. So again, the Bollinger Bands, we see that the price is testing the upper bounds as well of the Bollinger Bands. So we can see as well there is a signal of a potential squeeze or testing this phase of the below the resistance level. And the RSI, which is we can see reading at this level. So we can see it's recovering slightly from lower oversold regions and indicating that the pressure might be easing up temporarily. So the MACD as well, or the moving average convergence divergence, we can see that we see the values at the 105 level as well, or the signal line, and there is also a histogram of negative 8.16. So again, you can see the bars, it shows that there is a bearish momentum. It was dominant, but the bars are relatively flat and matching as well the sideways to recovering consolidation phase seen on the main chart. For the short-term consolidation or the recovery in the immediate term, gold is attempting to recover bounce and trading again at this 41 level with these candles on a lower time frame and also on a higher time frame. On a higher time frame, you can see it's more on a bullish trend, that you can see it's slowly clutching on the upward trend. Now, why both the DXY or the US dollar are elevated together? Let's take a look on the DXY performance. So right now it's 101 level, 1.131 will it again push beyond to 1.8 level as happened last time. So gold and the US dollar are rising together because of the tension in the Middle East. There is an escalating global. It's not just a specific region, but the impact of that specific region, it's really dragging the markets. So these global risks have temporarily overridden their usual inverse relationship, because usually they are in opposite direction, but right now it overridden their usual inverse relationship. Plus, because of this intensifying US-Iran tensions as well, the supply disruptions in the Red Sea and Russia, they have already sparked fears of there is a upcoming wider energy shock and rattled the global markets. So in short, there is a scenario wherein we can picture if there is incoming panic or in the market. So investors as well are rushing into both safe haven assets as a hedge against systematic uncertainty, inflation, and conflict. So that's why from time to time, we have to check those economic indicators that would really support evidence to the prices across the market. And rising oil prices are fueling inflation worries and supporting as well future rate hike expectations. Of course, it would also boost the US dollar and yield appeal, and the gold would rally as well on fear. Now, while gold and the US dollar typically move in opposite directions, so the macro and geopolitical cross currents can cause them to align or experience distinct push and pull dynamics. Another that we can see, so let's take a look on what happened last June. So last June, another example is that if there is another aggressive bank accumulation. So last time, the bank had accumulated major buyers like the China is one of the primary structural pillars for this one. So it keeps as well the gold supported over the long term, though we have to note that markets day-to-day momentum is also shaped by broader macroeconomic forces. We can track as well last month as provided by the World Gold Council as well, how we view the gold demand, and that would be not on just a short term, but rather medium to long term. So again, given this one, so again, another is the real yields and monetary policy. So gold thrives when real interest rates fluctuate or face downward pressure from shifting central bank easing cycles. And if there's a persistent macro risk, ongoing geopolitical tensions, high global debt, and also a trade fragmentation that keeps safe haven demand strong driven by investors to price in a permanent risk premium. And again, the DXY, the strength, so it caps the upside of a rising US dollar. It makes as well the gold more expensive for foreign buyers, and also it would increase the opportunity cost of holding non-yielding assets. And at the same time, it would also be capping the potential price gains. In terms of the Middle East conflict, it creates competing safe havens. In this geopolitical turmoil, it would also split safe haven flows between gold and the US dollar, and it can temporarily as well mute the gold's reflex rally when liquidity favors the greenback or the US dollar. And for the energy inflation, so while energy disruptions would spark inflation fears that support as well the gold, they also prompt the central banks to keep the rates higher for longer and maintaining elevated real yields that pressure the bullion. And while gold still holds ground, persistent accumulation by structural buyers like the central banks, it builds as well a resilient price floor that insulates the gold from short-term currency fluctuations and geopolitical cross currents. So given this scenario right now, gold uptrend due to the Middle East escalation as an example right now. So our overall outlook, yes, it could be on that way, but the path is still higher. But its path is higher. It is often constrained by competing monetary forces. So that's why we track as well inflation, then the central bank policy meetings. Next, the geopolitical safe haven. Regional military conflict and energy corridor threats, it would trigger systematic risk concerns and driving as well initial safe haven capital into gold. And the inflation and the interest rate that we keep on tracking, these are the headwind. So surging oil prices, it will fuel global inflation fears. It would then now, as a chain reaction, it would force the central banks like the Fed to keep the rates elevated, which in turn increases the opportunity and caps the rallies on the non-yielding gold. And structural support, despite there is a short-term macro friction, heavy central bank accumulation again, and global reserve diversification will provide gold with a strong baseline floor. Now, in terms of the US dollar is also going up. So the outlook for this one overall, normally it is acting a headwind for the gold. The USD is climbing or an uptrend, and simultaneously due to safe haven demand and shifting monetary expectations. Now, the ultimate global safe haven as well, severe geopolitical shocks like what is ongoing right now, it would also prompt institutional investors and the corporations as well to hoard liquid US assets and treasuries for immediate safety. Now, again, for the hawkish Fed expectations for the US dollar, so Middle East driven energy spikes, it would revive the domestic inflation concerns, and it would also cause the market to price in tighter monetary policy and higher interest rates that would naturally strengthen the greenback. Although the Middle East tensions, it drove both the gold and the US dollar higher as safe havens, a stronger greenback or the US dollar and higher interest rate spark right now a tug of war that tests the gold's broader uptrend against relentless monetary headwinds. So that's how we look on both of the USD or in the gold right now. So you can see right now, this is a lower time frame. This is the range or the spike of the prices right now. So given this one, it already the retest of 40.50 to 40.64 retest to break, and now it's surging to pass to 41,000. So would it also hit based on a lower time frame that is trying to test? Would it pass to 41.65? The next would be on the 42 level. That is how depending on how the market would react as well to the tension in the Middle East. Now, going back to currencies as well, the Japanese yen weakened past 160 per dollar to a 40-year low and pressured by oil prices and fiscal concerns, and also there is a wide interest rate gaps. Plus, we have the British pound. So it fell to below the 1.34, and during these political shifts in the UK and lower than expected public borrowing figures. And the US dollar, again, having this 101, supported by rising treasury yields, higher oil prices, and escalating conflict in the Middle East. And economic data showed there's a fourth straight down in the US private job growth. So it leaves right now the markets to expect steady rates at the upcoming Fed rate meeting with a potential hike priced in for September. Next, we have from the US as well. The US President announced a phased tariff schedule that will impose 100% levy on imported generic drugs starting in August 2028. Again, 100%. And this policy is designed to give drug makers a 2-year grace period to move their manufacturing operations directly in the United States. For the economic use, import prices, US import prices, so unexpectedly it rose to 0.3% in June, driven by increased costs for the technology, machinery, and a spike in prices for goods from China. And this increase as well, it pushed annual import prices up by 7.1%, marking the largest yearly gain since August 2022. And while falling energy costs, it recently helped as well overall consumer and wholesale inflation as well. So the Fed officials right now, they warn that there's a broader inflationary pressures remain, and with some policymakers, they argue for tighter interest rates. So having this one, what could be the influence in the United States economy and their indicators? So of course, again, in inflation, sticky non-fuel import costs having the 7.1% annual price jump proved that inflation is broadening beyond energy and threatening the Fed's 2% target. Plus the supply chains and the tariffs, so a sharp of 0.9% single month spike in import prices from China. It highlights right now of how this shifting supply chain dynamics and trade policies as well, heavily amplifying these expenses for the US businesses. And for the monetary policy, so these persistent cost pressures would diminish as well the hopes for immediate interest rate cuts, leaving the Fed officials arguing for tighter policy to curb inflation. And again, the market drivers, of course, in the news would be from the Middle East, the volatile oil prices that would really spark or fuel fears for inflation, and also a pressure ahead of the ECB ahead of its rate decision that would be tomorrow, and the upcoming sentiment surveys and the flash PMI data that will really measure the Germany manufacturing as well, plus at the same time the economy in the United States. Next, we have from the Germany. So German investor optimism has hit a 5-month high and driven by hopes that the Chancellor Merz' new economic reforms will also successfully boost growth. So this positive shift is reflected right now in the ZEW Institute Expectations Index, which jumped well above analyst expectations or the predictions despite ongoing global uncertainties like what is going on in the Middle East. So again, for the implication, Chancellor reforms support German stocks and keep bond yields stable despite energy risks, though broader market gains remain limited. And while future outlooks are really improving fast, you can see as a chart here provided. So again, weak current conditions and also volatile energy prices, they mean economic recovery will be very gradual. And strong European sentiment, it would also support the euro near the 1.14, but global dollar strength and geopolitical caution would prevent as well major currency jumps. While there is a surging investor confidence, again, that would strengthen the medium-term outlook for the German stocks, especially in the industrial and export sectors, and rising energy costs and geopolitical tensions would continue to limit immediate gains for at the same time for the index as well for the Germany. So again, having all this investor outlook, we are tracking for the energy prices. So that's one of the main catalysts since we have been tracking in first half of 2026. Now let's take a look on the German index now. So this is the current, it's already on the 25, and again, will it go back to the highest print for the German index again, going to 25. So again, the top performers yesterday were Infineon and Siemens Energy. So which stocks or equities to watch under the index, which is bringing weight for the German index? We have the SAP because it is as Europe's largest software firm and also a primary tech pillar for the Germany. Its performance really heavily sways the index technology sentiment, just like how we look on the S&P 500 and other tech stocks like the Magnificent Seven and the FANG. Now, Siemens, again, as well, it's also a massive industrial and manufacturing conglomerate that also anchors right now the broader industrial goods sector weight. Plus, we have the Allianz. So, it represents as well the financial strength and insurance heavyweight class for this one. It also gives a critical direction when banking or financial sentiments really shifting. Plus, again, we have the Siemens Energy. and the Airbus SE. So key players for this one driving the recent momentum via the power infrastructure and also the aerospace manufacturing. Plus, again, we just helped the index yesterday, the Infineon Technologies. So while there's a smaller in market cap than SAP, so it serves as well a crucial barometer for semiconductor and tech supply chain sentiment in the Europe. So you can see as well on the EMA, um, here valued right now near on the 24 level. So the price is here just above its major trend indicator and signaling as well a critical structural zone. So RSI here, and again, it indicates as well a moderate bullish momentum without yet crossing into overbought territory. And we can see as well the price level. So to defend, so we have the 25,161 level here, and we have the 25,815, the next price region where volatility is expected once it breached the 25,664 based from the hourly chart. So once this has been breached, the next target is the 25,815, and this is the next price region volatility that we could expect once this has been broken. So support levels, it's about around 25,420 and 24,726, which is the lowest boundary reference that we can take a look at based on lower time frames and the previous performance of the German index during the first half before even on the ending of the first half of 2026. So just to summarize what happened yesterday for the index, it climbed 25,000, and it was driven by global rebound in the tech stocks, and investors as well prepared for major earnings. So strong performances from chip makers like the Infineon, which I mentioned earlier, and the infrastructure providers like the Siemens Energy, it helped as well to lead the market higher. Meanwhile, we see the gains spread across industrials, the banks, and the healthcare, and it was supported by strong second quarter results from Novartis. Again, the market trend performance for the DAX recently, it went rebounded above 25,000 milestone. So you can see it is driven by the global tech sector. So again, we just like from the US, we are also being driven from this region with the tech sector strength and positive corporate earnings despite these high volatility energy prices. However, we should note as well vulnerability to short-term pullbacks and profit taking due to underlying overbought technical conditions. So for indicators like the macro news, so sentiment is heavily influenced by elevated oil prices and stemming from the Middle East tension. So it would also keep the rate hike expectations to remain for the ECB. And again, we also look on the strong export data from Asian chip makers that would also provide a fundamental boost to German semiconductor and tech equities. Again, for the technical outlook, so that index, it maintains a constructive medium-term bullish structure while holding above key moving averages. So key technical levels to watch here, as I provided already, near prior highs as momentum indicators as well elevated. So here, this is a lower time frame, but when we look on a higher time frame right now, it's already testing. So it's near at this level of 25. So will it go back, push again to extended to highs again for the DAX index? So to summarize this one, it remains in a structural bull market, and it is already characterized by short-term caution and choppy, because again, we are anticipating as well the ECB decision tomorrow, and at the same time, there's a range-bound trading as investors, they weigh on energy costs against upcoming ECB guidance. So again, stocks to watch for this one, we have SAP, Siemens, Allianz, Siemens Energy, Airbus SE, and Infineon Technologies. So that's for the DAX. Now for the indicators that we have to look, we have the consumer confidence, the Euro area ECB press conference, that would be also tomorrow. We have the interest rate decision, so we expect market would react. So if they are going to have more volatility expectations due to the interest decision and the press conference. Plus, we also have the latter part would be the S&P Global Manufacturing and Services PMI for the Euro area. So I guess that's it for today. Any questions relevant to the German index? Okay, so now if you want to join, just scan the code and register for our dashboard and start tracking the markets. And again, you can join our Discord channel, and the link is on the description box below. You can also check our copy trading. So here's our website for copy trading. You can really mirror their strategies while keeping technical analysis straightforward and easier to understand. Again, markets are moving fast, so stick to the plan and secure our lead and make it happen. So, thank you for joining, and I hope today's session provided you with some insights. Have no fear, Ira is here, all is well, and thank you for watching. See you on the next live session.